Okay, peeps, welcome back. So today we're going to be doing our macro markets overview for March of 2024. Let's get it. So a lot of you might be wondering, why do we do these videos once a month? Well, the answer is quite simple, because as a dividend investor, if the markets pull back, you're going to want to know about it because it gives you the opportunity to buy the dip. Generally speaking, the traditional financial markets and the crypto markets are somewhat correlated. So if stock indices have a pullback, i.e., the S&P, the Nasdaq, so on, there is a good chance that crypto may also have a pullback. It does kind of have somewhat of a bearing effect on cryptocurrency from time to time. It's not completely correlated, but there is some sense of correlation there. So, and also, if a major market crash were to take place, this is kind of our way to give you guys a heads up of what may or may not be coming. So, anyway, let's go ahead and get into the content. So, we're going to start out with the SPX here. As you guys can see, we are overbought on the SPX on the RSI. Pretty much every single time that we've ever hit overbought territory, as you guys can see here, we have had at least somewhat of a sell-off. If I actually move this over a little bit, you guys can see we barely touched it back here. And then we had a pretty large sell-off. We can actually just go ahead and measure each one of these movements real quick. So here's the RSI right here during the pandemic dump. You guys obviously know this crash was huge. It was about 35%. And then we'll go over to this one. This was basically the bear market top here. So pretty much measure it from there to the low. Another 26%. Does it, if the RSI is overbought, does it mean it has to have a massive crash? No. It just simply means that there is an increased probability that there may be a pullback on the horizon. Okay, it increases the chances of the bears stepping in and selling off the market and or bulls taking profit. So on this example, which we saw last year, there was about a 10% dip. We really wish we would have bought more Grayscale Trust back then, but is what it is. We only have so much capital to allocate, and that's just kind of that. So we could be looking at, if this thing is to pull back, anywhere from 11% to, I would say, probably, or basically about 6.5% to 11%. So kind of what we're looking at here is this zone that we have drawn out here between 4,600 to 4,800 to hold, and that's pretty much what it looks like. Other than that, other than the potential for a pullback and the targets, everything else looks very bullish. Something I do want to pull up here real quick is, of course, we always want to show you guys this because this is the bull bear indicator. This is the ultimate market indicator for us. So we'll pull up a 200 here, and we'll just make this a white line so it's really obvious. This is the 200-week moving average. This is basically a 4-year moving average. As you guys can see throughout history here, over the last roughly 15 years or so, this line has held as support to indicate a further move in the bull market. The only exception was the pandemic, where we had a fake out below it, and then the Fed stepped in, printed trillions of dollars, and then, of course, you guys know what happened next. So that level sits all the way down here at 4130. It kind of lines up almost perfectly with this trend line here. Do I think it's going to pull back that much? No. If we have a pullback, keyword if, it'll probably go somewhere between 4,600 to 4,800 would be my guess. So now we'll throw the other indicator back on here. And the only reason we ever use the 200 on the S&P 500 is because it's extremely accurate, and the S&P, as you guys know, is the gold standard among the indices. So that's that. Now let's get into the NASDAQ. As you guys can see, the NASDAQ's pretty heavily overextended, even on the weekly, which indicates that we are overbought. It doesn't appear to be so overextended on the daily, but that's the reason why we zoom out. So you all can see this from a bigger perspective. Again, we are overbought here on the RSI. The last 2 times that we had that, we did have a decent sized pullback. So this was obviously a bear market. This wasn't just a pullback right here. So a 37% drop. And then last year we saw a decent size 11% drop, which more or less lined up with seasonality. August, September, somewhere in there, it tends to generally be more bearish, historically speaking, throughout the year, whereas November to January is very bullish, and obviously we saw that play out. So if it pulls back, probably going to pull back to somewhere between 16,000 to 16,900 is what I would say on this one. Russell 2000, it did actually have a confirmed breakout of this resistance, so we can change this now to support. So if it does pull back, I would say it's going to pull back into the support somewhere between roughly around 2000 to 2030. And, sky's the limit on this. I'd say the next target's probably roughly around 2140 and then maybe 2290, somewhere in there. We're not overbought on this one. We are in bullish seasonality right now for the Russell, which is generally between December and February is the most bullish time of the year for the Russell, but we haven't seen like really outsized moves yet. So just kind of have to keep an eye out on that one. Dow Jones, once again, this one is also overbought, as you guys can see here on the RSI. No bearish divergence playing out yet. We haven't seen anything like that. So, but the last time we had this was back in April. Of course, we had this bearish divergence, and then eventually it did sell off. So when we got the overbought territory or overbought signal, it actually did go up a little bit. So it went up another 6% even after it was overbought on the RSI. But then when the dump did come, it was about a 22% drop. Notice the RSI is not overbought here, but we did have a drop in August of last year. And then, of course, the pandemic drop. And then there was this one back here, which I believe was, again, when the Fed started cutting rates because Trump at the time, if I'm not mistaken, of course, this is all, this is all assumed. We don't know for sure what goes on behind closed doors, but assuming that the Fed was forced to cut rates, it was about a 12% drop. So if this thing pulls back, it could pull back probably somewhere into this box. I would say retest it as support, resistance turn to support. So somewhere between 35,800 to roughly about 37,300 would be the pullback on this thing. So potentially anywhere from 3 to 7%. I am not saying this is going to happen. Just understand that this is a possibility. So now let's go into the stocks above the 50-day moving average. So we have had a pullback since we got to this basically pretty much everything in the green territory up here. It's kind of, well, it's looking a little bearish, but it's not like super bearish. So there's a possibility we could go back up, but pretty much every time recently that we've hit this overbought territory here, which is basically the perfect time to sell, we have had come back down to this green box. So keep that in mind. S&P 500 looks a little bit less bearish. I would say this actually looks more bullish than bearish, if you ask me. So S&P could be heading back up to that overbought territory. This is obviously the perfect time to buy back here, perfect time to sell up here. We show you guys this on the weekly. So there's a pretty good chance this thing is not going to move from overbought to oversold or vice versa in just 4 weeks. So do keep that in mind. So now we have the NASDAQ stocks above the 200-day moving average. Again, looking a little pricey, but do understand that the stock market can go up for a very, very long time and be very overbought for a very long time before having an actual pullback. It does tend to play out longer than most people expect. So as of right now, it's still looking very bullish. We're more towards the overbought than we are oversold. And there hasn't been any major FUD to hit the market, like the Fed cutting rates, uninversion of the yield curve, unemployment going up. We haven't seen anything like that. And we personally anticipate that we're not going to see anything like that. What we mean is we're not going to see unemployment go up. Okay. The Fed will cut, the uninversion of the yield curve will take place, and we suspect that there will probably not be a market crash. If there is, which again goes against the historical norm, it'll be very small. Reason being is because we think that the market's already priced it in back in 2022. So S&P 500 still looking very bullish. We're kind of sitting at these peaks up here. No real move yet. We're much closer to overbought than we are to oversold. But the good thing is, as a dividend investor, you get paid whether the markets go up or go down. It doesn't really matter. So if they go down, you just get more income for less money. If it goes up, then you get more profit, but less income for more money, something like that. So that covers the stocks above 50 and 200-day moving averages. The yield curve, as you guys can see here, has not yet uninverted. 2-year is still above the 10-year. That indicates that it is still indeed inverted. Again, we do not expect this to uninvert until the Fed cuts rates, which they have not started doing yet. So the Fed funds rate, not really much going on there. It's kind of just still sitting there. Again, they have been at a halt for probably, it looks like going on about 6 months now. Do understand that based on history, after some time, they will eventually cut. And when they cut, as you guys can see, the cuts are very aggressive. They do not come lightly. Okay. It does take a little while for them to actually cut. As you guys can see, this one back here took roughly around a year. This initial drop was from July of 2007 to May of 2008, so also roughly about a year. This one here from July 2019 to October 2019, that was only about 4 months. And then, of course, the pandemic hit, and they basically just dropped rates to the floor instantaneously. But that was a black swan event. So at some point, they will cut. Just do understand this and be prepared for this. This is part of the reason why we always have cash on the side. Because if the markets do have a horrendous drop, we want to be able to buy the dip. But again, we are making the argument that it was already priced in. And so therefore, if there is a drop, it's going to be small in comparison to what it would normally be. But we don't think there's going to be one. So inflation, not much has changed. It's still not below 3%. Core is coming down, but not much. Headline inflation is still coming down. Powell did come out recently on an interview and said something like, we're not waiting until inflation hits our 2% target to cut rates. That's not what we said, something along those lines. So we anticipate, based on that at some point in the near future, maybe the next 3-6 months, something like that, the Fed will start cutting. And they'll do it before it gets to 2% because, at some point they're just going to have to cut. That's the way the overall macroeconomic cycles work. So unemployment has not changed, as you guys can see here. So that's good. We want to see that stay stable, stay low, nothing changed there. That's exactly what we want to see. So now we'll go ahead and move over to oil. So the actual, well, you know what? Let's do the full size crude oil chart because this has a longer history. So the micros are relatively new. They're only like a couple years old, but the regular size ones have been around for eons. So as you guys can see here, the current support zone was flipped from resistance into support. It does appear perhaps we might have broken this trend line, so maybe oil is going to go lower. Don't really know at this point. And I just realized this is actually on the monthly, so let's go over to the weekly here. Yeah, so the trend line is broken, but we are still holding support. So oil could be vacillating somewhere between $62 to $77 a barrel. If we are to get a break of this downtrend line here, if that does happen, which sits at roughly around $84 a barrel, oil could spike again, head up to this resistance zone, or it could just head up to $95 a barrel and then get rejected. We'll just have to wait and see. But if it goes up, obviously that could be good for the price of oil. We will try to keep you updated on that. So now let's go over to precious metals. So you guys can see on the monthly time frame here on gold, it looks like we are having a new all-time high. So it's pushing those wick highs up there at 2150 or so. If we do get a close above this zone, I would say that now gold support sits between 1920 to 2082. If we have a bearish rejection, it comes back down and closes in this range. I would still say that's bearish, and the support would be between roughly about $1,400 to $1,460, somewhere in there. Silver is still not really doing much. This could be accumulation. It could be distribution. We don't really know yet. As long as the Fed has their rate hikes higher, I would say there's probably a higher probability that silver is going to go up. So the resistance is still between roughly about $30 to $38. Support is between $14.50 to about $8.90 per share. Palladium's still cheap, but still not in the buy zone that we want to see it in. So the buy zone is 860 to roughly about 1150 or per ounce, and 3,000 to about 3,440 per ounce on the resistance side. But again, we haven't seen that since basically since the Fed started raising rates. Because again, you guys have to understand, stocks and crypto are risk on assets. Okay, there's two forms of money that people are going to flock to when there's market uncertainty, when it looks like there might be an economic crash or a recession or something like that. Okay, precious metals tend to go up when there is a recession, so people flock to precious metals, and they will also flock to cash because cash is king in a recession. Because number one, you can buy prices at all-time lows, and number two, with the Fed funds rate being raised, the bank savings interest rates, certificates of deposit, things like that, are generally increased. So you get paid more money for sitting on cash versus being invested in the markets. So that's generally how this works. So now let's go down to, we'll take a look at platinum real quick. So platinum's still pretty cheap. Again, this could be accumulation or distribution. Don't really know yet. So support is between 700 to about 840, and resistance between 1180 to about 1340 or so per share. So the next thing that we're going to take a look at is, after metals, is we're going to take a look at Bitcoin. So we, generally speaking, cover Bitcoin in other videos, but we'll take a look at it here since we're already on here. So Bitcoin has actually touched a new all-time high. Believe it or not, that wick up there is actually a new all-time high. If you guys look really, really close at the charts here, we'll zoom out so you can see it. That did wick to a new all-time high. However, do understand that we did point out, okay, let's actually get rid of this so you guys can see it. We want to point this out one more time. We posted this on X. If you guys didn't see it, go check it out there. But last time Bitcoin was getting ready to break 2017 all-time highs in 2020, it did vacillate in that area for a few weeks before it broke out. So we could potentially be seeing something right now similar to that. I would say if it's going to vacillate, it's going to vacillate somewhere between 58,500 to the all-time highs. And then eventually, maybe in 4 or 6 weeks, something like that, we'll see a massive breakout to the upside. So now going over to the dollar index, we'll cover the dollar index next. Nothing's changed here on the dollar index. We're not expecting a massive breakdown until the Fed cuts rates, because that indicates to the market that if the Fed cuts rates, that indicates to the market that they are done fighting inflation, which means it's bullish for risk on assets. Of course, there could be a pullback in markets. We don't know yet. But if we're to see that transition from cash back into risk on, this thing will dump below this trend line and the support zone, which is what we want to see, and head down to this roughly $95 level. As of right now, the dollar still does look bullish because, again, the Fed has not cut rates yet. VIX, no major spike on the VIX. It's still kind of sitting at all-time lows. We may not see that until the inversion of the yield curve. That's just something to keep in mind, but we will keep you updated on this as we are made aware of these things. So anyways, this is the macro markets overview for March of 2024. Everything still looks very bullish, very similar to last month. Nothing's really changed. I would say that there is a slight probability of an increase for a pullback in the markets, but we'll just have to wait and see how that plays out. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and we will see y'all later. Peace.